Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I'm pleased again to have as my guest today, Brad Sorensen, who's a chartered financial analyst, a CFA, who is one of the members of our CFA consulting team with Cornerstone Portfolio Research. Brad, thank you again for joining us.
Thanks for having me. Glad to be here.
So, full disclosure for the viewers, recognizing how things can change on a dime. With the current administration especially. This is being taped on Friday, July 11th, and therefore is being aired on Wednesday, July 22nd. And therefore, we only know things can change. However, the reality of it is that the last episode we were talking about current conditions, the tariffs, the tax bill, or shall I say the big, beautiful bill, or what they call it. But where we left off on the prior episode, where I'd like to start off today, is talking about sort of the engine of the economy. Engine of the economy, 68% of the U.S. economy is consumer spending. Consumer spending is driven by the consumer being able to spend. And under what circumstances can the consumer spend? If they're working. And if they're working, they spend. And if they're not working or getting laid off or about to get laid off, then they're more apt to not spend. And again, where we left off, our jobless rate right now is 4.1 or 4.2%, which is considered lower than the 5%, which is considered to be full employment. So the labor market still remains strong. And so long as it remains strong, then the U.S. economy is probably going to remain strong as well. But I've heard you say it a few times, we're starting to show cracks. Talk to us about it.
Yeah, so that's what you want to. The unemployment rate is actually what's considered a lagging indicator. So that's always a month or two behind what's actually going on. I mentioned the JOLTS report, job openings, that's 2 months behind. So those aren't real-time indicators. And we all know the stock market is forward-looking. So it looks at what's called initial jobless claims, because that's considered a forward-looking indicator of the labor market. And there's a couple of charts that I gave you to just kind of illustrate this, that we're in kind of a middle ground, maybe a balancing of the labor market. You could say we see initial jobless claims. That's the first time that people file for unemployment. It's when they get laid off or quit or whatever. There's some rules about who can file for unemployment, but that's where they go. And the first time they do that, it's tracked by the government. Well, anything below about 275,000 a week, it's considered a good labor market, because there's always going to be churn in the labor market, as we talked about last time. And right now, we got up to close to 250 earlier this year, but now we're back in the 220s. So that remains a very healthy labor market by that measure. But within the jobless claims report number, there's continuing jobless claims. And those are the people that after they file initially, they continue to file week after week because they haven't found a job. Well, that number has risen to the highest number since the pandemic. And that indicates that we have a kind of market where businesses aren't firing people in great numbers. They're not laying off people because they still have business, they still have demand, but they're also not willing to really be aggressively hiring people because they're uncertain about the business environment and don't know if that demand will continue, and they don't want to bring on employees that they may not need. And there is just one little thing I want to mention, that we're still correcting from the COVID era. There's still some people overhired. It went from you couldn't find anybody to work. That was hard because there were all these stimulus payments and people were used to working from home and a million reasons why people didn't want to take jobs. So companies would hire anybody they could. And especially tech companies, they thought things were going to explode. So they just added to payrolls. Well, now we got to the point where they took a breath, looked around, saw what their demand actually was, and realized that they probably overhired So now we're correcting some of that slowly. So you do hear like Microsoft this week is going to lay off, I think it was 7,000 employees. Well, in the grand scheme of things, that's a very small number of the overall Microsoft employment picture, but they're just kind of correcting from that over hiring. So overall, what we see is the hiring is slowed, but they haven't laid off. So that's a what I would call a balanced labor market right now. And people have been used to a real employee friendly labor market over the last few years where wages are going up. There's help wanted signs in every corner. You walk into a restaurant, there's always help wanted. That has started to ebb as things have balanced out. Now, that's always the question. Do we do we stop at a balance level or do we continue to go down where job openings start to increase, layoffs start to happen? That's what we don't know. And that's why businesses are a little hesitant to hire right now. We don't see signs of that because demand has remained good, but that's the question.
Well, so when you reference that, particularly in the services sector, because first of all, I, manage my own firm, the single largest cost to my firm is labor. Similarly, and I managed another type of consulting firm years ago in the engineering world. And once again, the single largest component of your business expenses are labor. And since the services component is the larger than the manufacturing component, that is a way that a company can continue to support its earnings is by reducing its labor force. So it's a little bit of if this is a response to the tariffs or whatever the case may be, this is a way of they can absorb the costs by letting people go. And that's another complicating measure going into the whole equation.
Well, yeah, and I have to give you credit, Mike. This is the first interview that I've done where we've gotten, 10 minutes in, and you haven't mentioned AI. And that's a very rare thing right now. But that is also a thing that's starting to occur that, for example, Amazon now has more AI robots than they do human employees. Now they still have a ton of the human employees, but there's starting to be some jobs that are taken up by AI. Now, whether how widespread that gets, how quickly, that's also a question out there. Some people are predicting very quickly that we'll see a lot of layoffs and AI will take over a lot of these jobs. I think that's probably a little overdone because we've seen there's a lot of mistakes AI can make, and there still needs to be human interaction to make sure AI is not going off the rails in certain cases. But that's another factor in there that companies are looking into to help mitigate the tariff uncertainty that may come or the increased costs that come because of tariffs.
Well, so you bring up AI. Hey, I have a comment here. Anyway, so that was a lousy joke. So it's sometimes it becomes a shift in employment, and I'll use, while it's not exactly AI, it's robotics. If they replace a human with a robot that can do the same work, well, guess what? You need to hire people to build and create the robots and to fix them and everything else like that. So this could also be a shift in, if AI is replacing, well, you need more people to create AI. Furthermore, as we're seeing, AI is now creating a huge energy demand. And if there's a huge energy demand, now all of a sudden you need people to build the data centers and the cooling and everything else. And so it's kind of interesting how resilient the American economy is that when you create a hole, all of a sudden other things pop up and that it's just a redistribution. Is that a
Yeah, we've
simplistic
seen
way?
that. Yeah, we've seen that over and over again. That's why, you know, some people are scared about innovation, but throughout history, there's always been these periods. The classic economic graduate school example is the buggy whip manufacturers back, and they were worried about the advent of the automobile because it was going to destroy jobs because then we wouldn't need buggy whip manufacturers anymore. Well, obviously, the advent of the automobile unleashed an enormous amount of productivity and jobs and stuff. But what happens during these periods is there are, you can't go from being a Amazon self stalker to an AI programmer or a robotics person overnight. That takes training, so there's always some transition bumpiness that happens. And if it happens over time, that's what I think. It's going to be a gradual process. It's not going to be like overnight, hey, we're 20% of our jobs are going to go to AI. But over time, we'll have time to adjust to that. And like you said, workers will have time to train for new jobs in energy and nuclear and robotics repair in AI programming, et cetera, et cetera. So, and there will be jobs that we don't even know about yet that will be a result of this as industries expand and find new ways to do things.
Right. Right. Well, so we're heading into earnings season, Q2 earnings season. And as I recall, the discussions at the end of Q1, or shall I say in April into May when they were doing earnings, the whole issue was, well, we don't know what our profits are going to be because we don't know what's going to be the impact of the tariffs and we don't know the inflation, et cetera, et cetera. So, businesses were saying, we declined the comment, we plead the fifth, and they were getting away with it. So this is going to be a really important earnings season because it's going to answer the question that they didn't even want to answer, but then they're probably going to be thrust with the same, we don't know what's going on, but maybe I'm missing the point. Can you share?
Yeah, that is what will be the most interesting thing about this earnings season is how much will analysts press them? How much will they be willing, companies, management willing to narrow guidance? Because either companies withdrew guidance or widened it that it was relatively useless to a great extent. Once a few companies did it and they got away with it, almost every company did it. So we'll see, like you said, like I said in the last episode, that the range of outcomes with the tariff is still uncertain, but the uncertainty is narrow. Though we don't think we're going to get the worst case scenario, and we're probably not going to get the best case of no tariff scenario. We're going to get somewhere in between, and companies are getting some visibility into that. So I think we'll get some more color around the commentary this time instead of just basically it was just tariffs done. We're not going to give you guidance because of tariffs, but we are going to get some color around that and what they're seeing in the environment and how they're reacting to the tariffs to this point. And that'll be what drives the stock market over the next couple of months is how are they managing the situation and how do they see it going forward.
Well, one of the things is that I could see us having a higher than normal earnings beat. Companies beating their earnings simply because of the fact that we also have known in the past when a company does not meet its earnings estimates, its stock gets punished. So to prevent that, a lot of the companies in April were projecting lower expectations so that they should be easier to beat. Or am I missing the point on that as well?
No, you have it exactly right. That I it will be very disappointing if we don't see some decent beats. We're going into the second quarter with earnings estimates at about 5% year over year growth, and that's pretty low. That's the lowest level since 2023. And like you said, companies have lowered the bar, and analysts have gone along with that. And there's just this is an anecdotal, it's one example, but we've seen that yesterday that Delta a couple months ago, they were one of the first to withdraw guidance and say, hey, because of these tariffs, international people aren't going to want to come to the United States and they're not going to welcome that. So we think travel is going to fall off. Well, they came out yesterday and say, hey, that really didn't happen. We're seeing actually good demand and summer travel is really good. And so we're reinstating our guidance and we're doing that and the stock took off. Well, that just was a nice way for Delta to lower expectations and then come back with really the same guidance as they had in February, but then get a stock boost. So that's just kind of the way companies can manage, I won't say manipulate, but manage investors' expectations.
See, that's a great moral is, you know what? If I lower my expectations, then I have improved my chances of meeting my goals.
That's right. I do that with my wife all the time.
I hear you. It's something to take home with you every day. Brad, we're going to take a break at this moment. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we left off in the first segment starting to talk about the fact that we're entering second quarter earnings season. And the second quarter earnings, to Brad's point with Delta, is that when you put forth very low expectations, you lower the bar, it's easy to beat the expectations, and they did well. So we have a lot going on now. Everything is based on PE ratios, which is price to earnings. I say everything is based on it, but it's based on earnings. And if its price is too high, well, then it's a high PE. PEs have been growing again. And so this is going to be interesting because then it comes down to the E, which is the expectation of future earnings. So talk about the PEs then, Brad.
Yeah, first of all, that's one of the problems of what you talked about, the uncertainty that all the companies indicated in Q1. They withdrew a lot of guidance. So the E in the PE, the earnings forecasts got a little more uncertain. So then the PE ratio, that gets a little more uncertain. But what we've seen is it was very interesting. Coming into the year, based on historical levels, especially large cap stocks, were overvalued. They had higher PEs than traditionally they've had over history. That corrected in April, and they were back more to more normal levels because we had the sell-off, the almost 20% sell-off as a result of the tariff announcement. Well, and as I talked about, we had a forcing a less than 1% chance rally that spiked to new highs. And now we see, and I think I have a chart on that, that shows that PEs, especially along large cap stocks, have again accelerated to above historical average. We're about 22 times earnings right now. That just means that the price is 22 times what the earnings expectations are, and normal is somewhere around 18 to 19. That's what would be considered a normal. So we're not grossly, we got to, for example, if you remember the internet bubble back in 99, 2000 era, we got to PEs that were more in the 30, 31 range. And a lot of that was because a lot of those companies didn't even have an E. So they couldn't have a PE, or they had so low an E that the PE was almost infinity. So that this time, the companies that have led the market, the AI companies, the ones everybody's heard about, the NVIDIAs, the Apples, the Microsofts, they have great earnings. It's just how much do you want to pay for those earnings? And it's a little above historical average, but there can be an argument that because they're growing higher, that growing at a greater rate, that deserves a higher PE. So I don't know that that's a concern. It's just something to pay attention to, that between the great rally that we've had and the elevated PEs, earnings season needs to come through, or we might see a little bit of a pullback.
So that's a great point that you're bringing up, and this chart is really reflective of it because this chart shows the S&P 500 with a PE of 22, and then the top 10 stocks of the S&P 500 have a PE of 28, and that's basically your top 10, or your what they refer to as the Magnificent Seven, all of those in the AI, plus the next three largest ones, mostly, again, in the technology arena. And so the interesting thing that I talked to you about the other day is the PEG ratio and the PE divided by its growth. Well, if a PE ratio is 28, but it has an expectation of growing by 28%, then it has a PEG of 28 divided by 28, which is 1, which is actually very good. And a lot of these large companies have had rather significant growth, but it becomes the question of what is the anticipated future growth. That is something that you expressed concern, but we've been concerned about that for a couple of years. And these companies like NVIDIA just keep putting stuff out that just blows us all away. So,
Well, but interesting. Yeah, I just want to jump in there that, yeah, you make a good point that, and that's the important thing to remember is you can look in the past, but stocks always trade on the future. So that PEG ratio, is that growth rate going to continue? That's what this earnings season will help to hopefully answer a little bit. Are they seeing that growth continue? But what we've seen is with the Magnificent Seven, for example, well, it's not really the Magnificent Seven anymore. It's become more the Magnificent Four or Five because the two have stumbled a little bit and their earnings haven't kept up. And that's what can happen is when you've got this great growth, you get into the law of large numbers. It's something called that there's only so much you can grow. There's only so much money out there to invest in AI. It can't grow at 100% every quarter because we run out of money. Company boards are starting to say, hey, we love AI, but we can't keep spending at this rate. We'll run out of investment capital. So they may still grow at, this sounds ridiculous, but like NVIDIA, it may still grow at 30 or 40%, but that would be a disappointment down from 60 and 70%. So that growth rate has to continue to fuel these earnings rates. And if it stumbles, then it gets repriced because the PEG ratio gets out of line.
right. Well, that's interesting. And the other thing too is, as you pointed out in past discussions, is you said that shareholders are starting to push back on some of these companies that are spending all this money on AI. It's you're spending the money, show me the money. Meaning, and so the perfect example that I can think of is in the earlier days of Facebook as a stock, and I looked at it. I'm like, great. Where is it going to make its money? And, I was very bearish on Facebook in the very beginning, but then how did they figure out how to monetize it? Because then they started getting advertising dollars like, okay, that's how. So the question then becomes is, how is AI going to do it? Are they going to start charging for ChatGPT and the various different AI things, and companies use AI for their own purposes? I guess that's the next step that these companies need to do, is to be able to find ways to monetize it.
Yeah, and that's what we've seen is we've already seen, and like I said, stock market's forward looking. So they're looking at the next thing. AI is obviously still like if you can remember back to the internet, it was the guts and the nuts and bolts of the internet that it was the initial rally, the Cisco's, those kind of companies. And that's where we are right now, where the NVIDIAs, the chip companies, the providing the chips for that. But now investors are starting to look beyond that. What's going to benefit from AI? How are the AI companies? Like how is Microsoft going to make money off of AI? How many people are going to buy Copilot, for example? And you can see the most interesting current thing going on is Apple investors are revolting against Tim Cook to a not insignificant degree, even though since his reign, the stock is up over 1,000%. Apparently that's not good enough for Apple investors because their AI rollout has been not the best, I would say. So they're disappointed in that. So the expectations are high, but now investors are looking at who's going to use AI. And you've already seen that to some degree, because one thing we do know is AI takes a lot of energy. And so we've seen energy companies, especially on the nuclear side, really spike up over the past 6 months as investors have moved to the kind of first derivative of AI. Okay, AI is good. What's it going to take to run the AI? and now who's going to benefit from the AI. And that's where we're going to listen to earnings season. Are we starting to see companies say, hey, we can reduce costs by 30% because of AI? We can add to this product line without adding costs, so revenues will go up, those kind of things. And that's what will really be the interesting thing to hear over the next couple of quarters and probably a couple of years, actually.
Yeah, that's kind of what I was thinking, because we haven't really seen the benefit. I mean, we've seen the benefits, but from an economic perspective, we haven't really figured out. For instance, the thing that I always think of as one of the greatest benefits of AI is in the healthcare industry and in the biotech and the research. They're able to use AI in such a way that it'll improve the ability to diagnose, to treat rare diseases or find cures. But we just haven't figured out the big AI providers. How are they going to do it? But hey, you know what? Like you said, it's just like the internet. When the internet came out, I remember, you ready for this one? I'm showing my age. I remember, I think it was 1987, when I saw someone at a company that I worked with get a fax machine. I'm like, a fax machine? First of all, what in the heck is that? And secondly, who in the world could possibly need a fax machine? And now all of a sudden you come to realize the importance of the fax machine, which has subsequently been replaced by emails and email attachments and stuff like that. But it's remarkable how innovation works its way into the overall economy and distributes itself.
Yeah, exactly. And that's a great point. And you probably just said something that at least some of our listeners have no idea what you're talking about, because they have no idea what a fax machine is. But yeah, and that's the important thing to remember, is that's what makes investing fun to me, and that's what makes the economy go, is what's the next thing? How's the American economy going to adjust to this? How are AI companies going to make money? Like I said, American companies know how to adjust. How are they going to make money off of this? And how are companies going to benefit from this? The current beneficiaries, unfortunately, the heaviest beneficiaries seem to be students that use AI to write their papers. And my wife's a teacher, so luckily she's only in fourth grade, so they haven't really figured out the AI thing. But that's a big thing in colleges and high schools. My daughter's in high school, and they warn about AI. And so there's always, and that's the other thing with new technologies, it's always the criminal element. I'm not saying that's a crime necessarily, but it's always kind of the dark side of that technology that gains a foothold first, and then we figure out the good ways to use it. So that we're seeing that a little bit, but it will happen, and that'll be the fun thing to watch over the next couple of years.
Well, it's interesting you referenced that, and especially with your wife being a teacher, because back in the day also I was a teacher, and I did a lot of tutoring, and only math, because I still don't really have a good grasp of the English language. And what I intentionally did is I would take their calculators away, because it's almost like the AI, they rely on it. If you teach them how to do the math, the calculator only serves as a tool to make it go faster. I think it's going to be very important, much like the use of our phones these days. The use of our phones are basically like a handheld computer. Not like, it is a handheld computer. It's a function of, much with AI, is learning how to use it to your benefit, and not, again, in a malicious manner, which is one of the things that concerns me of what you see on TV. Is that really an interview of that particular individual, or was it manufactured? The phone call you receive from your daughter who's in jail and needs money, when in fact, they're not in jail or whatever. Those are the concerns. I'm kind of going off, not really, I'm just saying stuff, but AI is a very interesting thing, and it'll be curious to see, but it is here. And I think the comparison to the internet is a very strong one. We haven't really figured out yet the impact, but it's going to be part of everyday lives from this point moving forward.
Yeah, definitely. And that's what, as we get back to earnings season, that's what to watch for, is how are companies starting to use AI. And that'll be fun, but also instructive on what industries are at the forefront of that. Those might be the next big thing. But that's what to remember. Some of those will be smaller companies that figure out how to use AI to really bolster their operations in various ways. And small companies, on the other hand, are undervalued. So we saw at the beginning of the year, internationals outperformed, and they had really low valuations. So we could see a little bit of a rotation into those small and mid cap companies that have lagged so much over the past couple of years. So that's why we maintain diversification and suggest investors stay diversified among the wide variety of asset classes.
Which, by the way, I will have you know, very interesting you pointed that out, is just this morning I took a look at it, and your stock market is up about 6% year to date, roughly. Bonds are up about 1.5% year to date. Yet a diversified portfolio is up more than stocks and bonds combined, which just is, to your point, it shows that diversification really helps. Now, it's unique that happens, okay, that the diversified portfolio actually outperforms all the components, and international is part of it, because I remember I always complained about international is that in the last 12 years, there's only one time that international outperformed the United States, and that was in 2017. International did 38%. Well, US did 35%. That's not much of an outperformance, in my opinion. I'll be happy with the lagging of the 35%. It's all of the other 11 of the 12 years that it lagged significantly. But to your point, it's demonstrating diversification doesn't prevent losses. It just spreads out your risk and gives you the opportunities in some of the smaller areas.
Yeah, exactly right. It smooths out those returns. And that's where, if you have a long time and can handle a lot of risk, maybe you don't want to be as diversified. But for other people, it smooths out those returns, and people that had a decent international allocation didn't suffer as much during the downturn in April. And that just shows there are other things happening out of the top 10 stocks that investors, and the next big thing, Nvidia used to trade at $1 or $2 a share, and they were a small company. So those companies are still out there, and that will happen, and you want to be exposed to those as well.
Oh, of course. I want to know which ones they are so I can get them. I wish I bought Nvidia 20 years ago or even 10 years ago. Wouldn't that have been nice? So, Brad, I thank you very much. Is there anything else that you want to add? I'm not going to ask you to give a prediction, because I think that's unfair. Is there anything else that you want to add on a look forward basis? I mean, we've got all the elephants in the room, or the 800-pound gorillas. We've got a lot of 800-pound gorillas. This is like a zoo. But anything else that you want to add?
The only thing I would like to add is that, no, my crystal ball is not real great. It's kind of cloudy, so I'm not going to make predictions, but my thoughts are that we'll continue to manage this well. We may see another little pullback, like I say, with valuations and kind of summer doldrums. We could see a pullback, but I don't think it would be anything severe. I think if we get an economic downturn, it would be very shallow, because the Fed is ready to act if they need to. We've seen that they're watching that employment number very closely, and that's the second part of their mandate, employment and inflation. So and I think they've shown that they're more concerned about employment right now because they're biased towards a cut. So there's all these things that can happen. And the president has shown that he cares about the stock market, and that he will react if the stock market has too many problems. We saw that with the pause. That was more the bond market that forced that hand. So that all fits together, that things should be, though probably will continue to be a little bumpy, but the general direction is up and to the right, gains over the time, and investors should just relax and not pay attention to the day-to-day news.
That's very well put. Don't pay attention to day-to-day news. The one comment that I do want to say is it seems shallow or useless or whatever for a president to care about the stock market. But one of the things that I've noticed is when the stock market is doing well, it creates a psyche of the consumer that gives them the feel that they're wealthier and that they can spend. And it's almost like gas prices being low. You see it 5 times a day just driving from one place to another.
Yeah, and over half of Americans have stocks now. So no, it's a very important part of the American economy. So presidents should pay attention to it. The degree to which that is done and social media talked about is debatable, but that is a major part of our economy.
It sure is. Brad, as always, thank you very much for the insight, and you're just open talking on all the different topics. And I look forward to having you next quarter when we do this again. So thank you very much, Brad. Much, much appreciated.
Thanks for having me.
And thank you for joining us, and I hope you had an enjoyable educational experience, and we look forward to seeing you on the next week of Financial Planning Explained. Have a wonderful day. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there's an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.